Hey friends, Kevin Burgess coming at you with actually a pretty rare edited video. I wanted to share with you the top 6 stocks to buy now. Just to give you a little bit of my history, in 2021, I retired and I left the world of corporate finance. I left the boardrooms of a Fortune 200 company and I retired. I actually retired early and became what I determined to be the chief investment officer of the family portfolio. So since that time, it's been about almost 5 years now. Since that time, I began investing, and I've made some good investments and some bad investments. But most importantly, I have learned a lot in that process. So at the end of 2024, which was about a year ago, I decided to build a model for the information that I was looking for to determine what I thought were the best investments. Now, this model is based on the theory. It's kind of like a Wayne Gretzky theory that says, let's skate where the puck is going to be, not where the puck is. And I think a lot of times the apps that we have access to only give us the information for today. They're not really predicting where these stocks are going to go. So this model I developed and been using it for about a year now. And I'll tell you, let me show you some of the results here. The results are pretty good. The through October 29th, which is yesterday, the portfolio has returned 19.38%. The S&P is at 18.38%. So we're beating them by 100 basis points. Now, the NASDAQ has gone absolutely crazy over the last few weeks. It is now at 24.7%. I look for a more diversified portfolio. I'm not 100% in tech, but it's not a bad idea if you're young to get really tech heavy. The Dow, we are beating the Dow by 588 basis points and the Russell 2000 by 676 basis points. Again, this is just a model that looks at total return. And so it actually will, for me, it will raise stocks up in the model that tell me that they are better than other investments. Now, I will say that I have not used this model for 100% of the portfolio. I have used it, sparingly because I wanted to test out the model. But there is an account that I used this model specifically for, and it is up 40 plus percent. So I think the model is ready for use. I will say this, I am not sharing this so that you can buy or sell any particular stocks. This is really just me sharing my journey, me sharing with you what I'm seeing. You make your own decisions, you do your own due diligence, but these are 6 ideas for you to dig further into to see if they may add something to your portfolio. The first one is Microsoft. Now, I know what you're thinking. You're thinking, oh, these 6 are going to be, Microsoft, Google, Tesla. No, they're not. This is really the only mainstream stock that I have on the list today. It is a company that you are very familiar with. They were founded in 1975. They've evolved really into a global technology leader with a diverse product portfolio. They have some software products, many of them you are familiar with, and that would be things like the Windows operating system, Office Productivity Suite. They also offer cloud services such as Azure, and they are just basically killing it. We'll look at some of the numbers that I'm looking at that tells me that they are a buy at this point. This is Microsoft Corporation. This is part of the model that I have built. It is a model that shares some of the most important information, not everything that I look at, but the most important stuff. You can see Microsoft here. I have it rated as a buy. It is what I believe to be a potential of 14% return over the next 12 months. Analysts are saying it's going to be somewhere in the 19% range over the next 12 months. My goal for the portfolio is to be at an 8% return on an annual basis. Since I retired in 2021, it has actually generated 12.5% return on an annual basis, even though I was really trying to learn about investing. So now that doesn't mean that I know everything, and it doesn't mean that this model is not going to get better and better over time. But I really like the results that we're seeing. So Microsoft, I think, is a buy. It's got a wide moat, according to Morningstar. It also has, it's about 12% undervalued, according to Morningstar. So and the return on invested capital, a whopping 28%. We like this. It's got a medium fair value uncertainty, which is pretty good. They have a dividend safety rating, according to Simply Safe Dividends, of 99. It's the highest model, or the highest that app gives a stock, highest rating that it gives a stock. The payout ratio is a meager 24%. And if you don't know what the payout ratio is, it is the amount of dividends paid out by a company divided by their earnings. So basically, Microsoft is paying out only 24 cents of every dollar that they earn. And so that gives them the ability to invest 76 cents of every dollar to build the business. We like that. We don't buy low payout ratio companies because we want them to pay us more and raise that payout ratio. We want them paying us, but we also want them reinvesting in the business because we're about total return. Then the dividend yield is actually pretty low. It's at 0.7%. So if you are seeking a high interest dividend yield or high dividend yield, this is not your stock. But I do have some options here for you as one, in the six companies I'm going to talk about. Also, they have a buyback yield of about 0.4%. And so therefore, the total shareholder yield is 1.1%. It's pretty low, but at the end of the day, it's got a lot of potential from a growth perspective. So that's number 6. It is actually number 6 on the list. Number 5 on the list is going to be Intuit. Intuit is a company that was founded in 1983, and it provides innovative financial software solutions for consumers and businesses. They've developed popular tools like TurboTax and QuickBooks, and mainly their purpose is to simplify financial management and tax filing. They have begun to expand their offering through innovation, but also through some strategic acquisitions. Here we go, Intuit. I've got it as a buy rating. I think it's got a potential for 17% return over the next year. Analysts are saying 23%. It also has a wide moat, according to Morningstar. It has a fair value of 92%, meaning that it is undervalued by 8%. It's got a 15% return on invested capital. Again, a medium fair value uncertainty. And dividend safety is 98, which is a very, very good. Payout ratio of 21%. So very similar in structure to Microsoft. It also has a dividend yield of 0.7%, but has a buyback yield of 1.5%. So the total shareholder yield is actually a little better than Microsoft's at 2.2%. So let's look at the third company we're going to talk about today, and that is Amphenol. Its product focus is on electronic and fiber optics, critical for modern technology. So all of this AI stuff that's going on, Amphenol is incredibly important for the infrastructure of getting that data where it needs to be. So they serve automotive, aerospace, telecommunications, with high quality connector solutions. I think of them actually very similar to the way Parker Hannifin is for the small important parts for things like space, aviation, but Amphenol is that for electronics. Let's take a look at the numbers for Amphenol. Now, I showed them as a buy with a potential of 18% return. When I first started investing in Amphenol, that number was much higher. It has gone bonkers over the last year. I think I'm already up over 100% on the shares that I bought in Amphenol, but I don't think it's done. I think it's going to continue to grow. Analysts are saying 4%, so keep that in mind. Do your own due diligence here. They have a wide moat. Their fair value, they are roughly at fair value. According to Morningstar, they're about 3% above fair value. And the return on capital is a whopping 23% with a medium uncertainty. Dividend safety is 87, which is pretty good. Their payout ratio, again, is in the low 20s, which we really like. They also have a dividend yield of 0.7% with a buyback yield of 0.4, giving them a total shareholder yield of 1.1%. Now, so far, these three stocks have all been growth type stocks with low dividend yields. So if you're looking for total return, these, I think, are good stocks to consider for your portfolio. So let's now take a look at the next stock on the list, which is Hess Midstream. Now, those of you who like higher dividend yields, you're going to want to pay attention to this stock. It has taken a beating over the past couple of months, but it's a solid company. It has basically one customer, which used to be Hess Petroleum, but it is now Chevron. Chevron has completed the acquisition of Hess. Chevron has determined that they are going to use fewer assets out of the Bakken region, which is where Hess Midstream is. It's caused the stock to get a little bit of downward trend. They've been recently established. It's probably been about 8 years ago, maybe. They're established as a subsidiary of Hess to focus on the midstream operations of the oil and gas industry. The company operates the key midstream energy infrastructure, including pipelines and storage facilities. It says across the U.S., but it is mainly in the Bakken region, like South Dakota, Minnesota. That's where its major focus is. So let's take a look now at the numbers for Hess. I show Hess Midstream with a potential total return of 19%. Analysts are saying 17%. So we're in a pretty good company there. They have a narrow moat, according to Morningstar. The first three stocks we looked at all had wide moats. They are currently trading at fair value with a return on invested capital 22%. Very solid returns from these companies. Their fair value also is at a medium uncertainty, which is a good number. Their dividend safety is 40, and why I think that is because they really only have one customer, which puts them at more risks than someone who has a broad diversification of customers. They have a payout ratio in the 61% range, but that's not unusual since their dividend yield is 8.6%. 8.6%. They do have buyback yield, but the way they do it causes it not to show up in the financial metrics. So I'll just leave that alone for now. But even with just the dividend yield, it is 8.6%. So if my goal, which I mentioned earlier, is to have a portfolio that's producing at least 8% per year, 8.6% gets me there. So it can be a flat return, and I'm still at 8.6%. And it has actually done well over the past few years, but here recently has had a pretty stiff resistance. So let's take a look at the next stock on the list. This will be the fifth stock, or the second rated stock. Second highest stock will be ConocoPhillips. It is also in the oil and gas industry. It is founded in 1875, so it's been around for a while, 150 years or so. So it's got a long history. It is one of the largest independent companies in the oil and gas exploration and production worldwide. ConocoPhillips plays a significant role in supplying energy to global markets. So it is a solid company. ConocoPhillips is I show it as a buy, 22% potential annual return. Analysts are saying 32%. So as you can tell, most of the time, my model is going to be conservative compared to analysts, but not all the time. Sometimes it will. It also has a narrow moat. It is trading about 17% below fair value. Has a 12% return on invested capital with a high fair value uncertainty. So it is important to recognize that this fair value could be a bit off on ConocoPhillips. They have a 61 in dividend safety rating. Their payout ratio is 43%. They have a unique setup where they are actually buying back a lot of shares. So they have a 3.5% dividend yield, which is pretty attractive. It's an above market dividend yield, but they are also buying back about 5.4% in shares, meaning that they have about an 8.9% total shareholder return. So if you're interested in both a dividend yield and buybacks, ConocoPhillips is one that might be worthwhile to take a look at. So now let's take a look at the last number one on the list of buy shares. It is CorMedix. Now CorMedix is the only company in my portfolio that is not a dividend payer. So it has no dividend yield. It was founded in the early 2000s, but it has a product called DefenCath, which has just been approved maybe about a year or so ago by the FDA. That product is now in the market and has really grown fast. They have acquired a company called Malenta, and Malenta provides for them 6 other products as well as a infrastructure that will go and allow DefenCath to be sold through that infrastructure, but also bring DefenCath can bring to the table for those other 6 products a market as well. So I think this is truly a stock that has really begun to grow. It is a multi-focused stock now, not just on a single product. So I think you're going to be excited to learn more about this company if you don't know them already. So that's my top 6. Again, I want you to do your own due diligence here. Now, this is a rare edited video for me, although I'm not going to edit much of it. I normally come to you live on Monday nights. So if you are interested in joining us live, look for me usually around 8 o'clock Central Time. So we'll do live. You can ask me questions, give comments or whatever. And also, if you are interested in joining us on the Discord, I'll have that link in the notes to this video. So with that, take a look at these 6 stocks, do your own due diligence. Hopefully you'll come away with some really cool ideas for building your portfolio. I'm here to help you. I'm not here to tell you what to do. I'm just here to share with you what I'm doing. Hopefully this helps. If it doesn't, it didn't cost you much. Awesome. It was worth the time. So with that, I'm going to get off of here. I will see you on the next video. Have a great day.